Hello, everyone. Thanks for tuning in to our little webinar today. We started doing these sessions a few months ago, and we always do a session in our main channel in Slidebean, which covers the sorry, there we go. Yeah, we always do the session in our main channel in Slidebean, which covers kind of like a broad overview of fundraising and so on. And we reserve this session for people on Zoom and for people on our Startup Club channel, because this is going to be a really deep dive session into like what fundraising looks like, how you should tackle it, how you should budget your future funding rounds, because it's honestly not that complicated. It's honestly not, but I think a lot of founders get lost in get lost in the tracks. And I think that we've come up with a pretty decent system to let you solve this without so much pain. So I have a bunch of templates that you're going to be able to download and access. They're all free. So just stay on top of those chats for the links and for questions too. I've gotten better at multitasking, so I have the webinar chat here on one side, and I have the YouTube live. I lost it, but I had it. I have the YouTube live stream here too. So if you have any questions that you want to drop along the way, I'll either stop and answer them for you right away, or otherwise we'll save it for the end and still cover it. Okay, so let me have a bunch of screens open. I'm sorry. Uh, it's a bunch of screen sharing and different screens to look at, but here we go. Okay. So how to budget a funding round for your startup. Let's get to it. Oh, by the way, we're doing this on Zoom for people who signed up for our platform, and we're doing this on YouTube too. The recording is going to be there on YouTube. I always get that question, but also we're going to try to build a model for one of you in today's session. So especially for you guys on Zoom, if you want us to kind of tackle or take an approach to your business, today, we'll do it. You'll raise a hand when it's time. But for you guys on the YouTube live stream, you can just join the Zoom as well if you want to have a two-way conversation about all that. Okay, so let's do it. Yeah, so the only reason why we started doing this is because we've been helping founders prepare for their fundraising for a good amount of years. It's been about 13 years since we started Slidebean, or it's going to be. And over 2 million companies have gone through our resources and through our platform. And we've seen this problem come time and time again, right? This common problem with numbers when founders are doing forecasts. The first one we see really often is that the round size, the amount of money that a founder intends to raise, is just this arbitrary number, right? We're raising $1 million, we're raising $2 million, we're raising between $3 and $5 million. That's usually a telltale sign that something is off, right? That something is not, that someone hasn't done their homework on how much money they actually need to get their companies off the ground. So that's one. The other problem that we often see is that the growth projections are just too optimistic. They have this hockey stick charts for revenue growth, which is usually another sign that somebody didn't do their homework to understand like where that growth is going to come from. And we'll get to this in a sec. And then the last big problem, one that we fell victims to as well when we started Slidebean, was that we forecasted around a certain runway, right? We raised money to last for 18 months of runway, and we didn't really think about raising money to reach the next fundable milestone, or the next point in the company where you can go out and reach out to investors and try and raise money. So those are three mistakes, and all the stuff that we're going to cover today is going to help solve those and not make those mistakes again. So the answer to this question, right? You might have been asked by an investor, for a pro forma template, or you might have, maybe your company is running and you're trying to calculate your runway and how much runway do you have left. You may have been asked for your legal doc repository or for your data room and all these questions. And the answer to that is usually in the form of a financial model. Now, I hate the fact that this thing is called financial model because it sounds like a finance thing, but in reality, it's not too different from a budget sheet. There's a good chance that you're already using some form of financial model in what you're doing. That wouldn't be crazy. So let's actually look at how one of these things look, and start with some basics. Okay. So we've color coded everything here, and hopefully this serves as a good reference to how these things could be could look and hopefully simplify it a little bit. Notice that here we have dates, right? So this is 2025. We want to switch this to 2026, but we actually have a setting for that, and there's some good tools to do that, right? So you can change that, and that changes the date across the entire model. But notice that we have three main components here that we're looking at. First, it's revenue, right? That's color coded green. And then we have costs, right? The big difference between costs and expenses, we're going to dig deeper into this as we move forward. But at the very basic, let's assume that your company made $1,000 in revenue, 10,000, and that in order to make that revenue, you had to pay for server costs to host your platform. And maybe this is an e-commerce, so you had to ship items. So you had shipping costs. Let's add shipping here. Let's call it servers and shipping and products, right? And you had to spend, I don't know, about $1,000 worth of shipping, and you had to buy these products that you sold, which cost you another $2,500, right? So what this is basically telling us here is that, well, you made $10,000 in revenue, but you spent $4,000 to make that revenue, which means that your gross profit margin is 6,000. Gross profit margin in this context means, well, how much money at scale does your company make? The crucial part about gross profit is that your gross profit should always be positive, right? If for example, your products cost $8,000, I don't know, $9,000, and you spent 1,000 in shipping and 500 in servers, your business loses money, and there's no clear way to recover this because in theory, all your costs are going to scale proportionally to your revenue, right? If you make more sales, you're going to have to spend more on shipping. If you make more sales, you're going to have to spend more on the product. And if you get more traffic to get those sales, you're going to have to spend more on servers. So because costs are more or less tied to revenue, if your costs aren't positive, then you are in trouble. And gross profit margins for software companies tend to be in the 80%, 90% sometimes. For e-commerce and other businesses that sell items, those are lower. They tend to be in the 50, 60, I think wouldn't be too crazy. But there are other expenses other than costs, right? And that's why we have that separation, because gross profit margin should always be positive. It's always positive, right? But also we have other stuff as well, right? And understandably, sometimes businesses lose money. And when businesses lose money, that's usually because of this section here, because of sales, general, and admin expenses. We can set a team salary. Let's say that we're going to start a company. I'm going to take Bob here from the Zoom webinar, and let's set Bob on a salary of, I don't know, 75 a year and set a start date of January, right? So notice that by doing that, we have some stuff that's happening automatically. We are dividing this annual salary into months. I'm going to be Bob's co-founder too, and I'm going to add myself as well. So we have this. So now we have this budget here of 2 salaries. We can add other expenses here as well. Maybe we're a little old school and we want to rent a small office, so we'll have to pay, I don't know, $1,000 a month for that on WeWork or something. And so we have all these expenses, 13,500, right? Which again, this business is, in theory, on paper, it's profitable because the business that we're doing, which is selling these things against their shipping and product costs, that is profitable, right? That there's positive gross profit. But after we add our own salaries and our own expenses, we're in the negative, right? And that's fine, right? In the sense that, well, eventually this gross profit margin will be large enough, will start growing so that it'll cover our own sales, general, and admin expenses. But again, differentiating between these two and how one scales with revenue and the other one doesn't, that's key to everything. Okay, but let's do a little more. Let's dig a little more. Notice that I have here this SaaS revenue source for this business. So I'm gonna zero this out, this revenue source 2 that I played around with, and I'm gonna show you a little bit of what a financial model does, or a little bit of what this spreadsheet can do, or what a spreadsheet can do. Notice that here we have this line for new clients. Notice that every number that I've been editing has been blue, and this is kind of a rule that finance people use, but that we adopted because it is actually good. Finance bros got this one right. It's easy to identify stuff that you want to input, that you want to change in the spreadsheet, by looking at the blue numbers, right? So blue numbers are inputs, and black numbers are formula results. So here, if I change this, the total here changes, and I don't have to go and add it myself. That's all coded in already. So here, these numbers being black means that they're going to be estimated automatically, and my input here is going to be the blue numbers. So let's say that Bob and I, we go and start this business. It's a SaaS business, and we assume that we're going to launch this product, let's say in April, right? So in April, we're going to assume that we're going to get 50 customers a month, and I'm going to drag this number along all across this row so that every month we assume that we're going to get about 50 customers. Great. Now there's a churn rate. If this is a subscription, people will pay us every month, but we might lose some customers because of churn. That's fine. We'll leave this to maybe 5%. And then the other input that we need is our MRR, right? How much are we charging for this product? What's our monthly recurring revenue? Let's maybe set this to 99, right? It's going to be a $99 a month product. So every user is going to pay us $99. So we'll get 50 users the first month. That gives us 4,900. The next month we'll get another 50. We'll lose some of them because of churn, but we'll end up with $9,600 in revenue, and so on and so forth. So notice what happens here, right? If we go through this final row on net income, we have negative, right? We're spending money because Bob and I are paying ourselves. We're losing money every month. But as revenue grows, right, as our subscriptions grow, again, revenue scaling because of these assumptions that we're making, we turned this into the positive, right? We turned this into profit. We now have net income in this business. We can look at that. We have an annual version of this sheet. So notice how this business is scaling from $195,000 the first year, then 600, then 800,000, and then up to $1 million by year 4. So Bob and I might sit down and say, well, we've got something here, right? If we add all these customers every month, if we add about 50 customers every month, then we'll be on our way. We'll make $1 million a year in this company. Now, there's a problem with this. There's a problem with this spreadsheet I've been using. It's trash. I've made one crucial mistake with the way I forecasted growth in this sheet, and it's a mistake that a lot of founders make as well. Did anybody catch that? Did anybody catch what the mistake was? I'll give you guys a sec on the Zoom webinar to type it in if you think you've got the answer. What's wrong with this spreadsheet? What did I do so wrong? And it's one of the mistakes that we talked about earlier. I see from Sherry, growth needs to slow down after a while. Not necessarily. It's going to be a straight line graph. Yes, but that's not necessarily bad. That's not it. That's not it. One thing that I could do, and let me go back to the sheet to show you. I need to hire more people. Okay, maybe you're maybe on the right track somewhere there. We're missing something, right? So here's one thing I could do to tackle it, to growth not being constant, right? One thing I could do is I could go here and say, well, we're gonna get 50 customers every month. That's what I said originally. And well, what if I take this and multiply it by 110%? Right, so basically saying we're adding 10% more customers every month. And I can drag this formula along, right? I can drag it across the entire sheet. I see more answers coming from YouTube. Where do I find this sheet? I'm not going to give you a copy of this one because this is the one that's trash. I have a better one, so I'll get to that. And it's a free download, so don't worry about it. Don't worry. I'll get to that link. COGS not for all months. That's one mistake we made. That's true. We haven't followed up on costs, and we have to assume that there is one. So that's a good catch. But I think Java Works caught the error. No marketing cost or driver. That's the right answer. So notice what I did here. I took this and multiplied it by 110%. Fabulous. Can go to FS annual, and suddenly this business it's a freaking great business, man. Going from $1 million net year 2, $500 million year 7. That's it, right? Like we've got ourselves a unicorn, right? That's kind of the problem that that founders make, and again, that's the reason why I would call this trash. You got it right, Java Works. Ali, you're on the right track. I got this from an actual founder that showed me their model. Hey, we're going to generate 700 orders when we launch, and then this number is going to scale 10% every month, right? Every month we're going to add 10% of orders. And he did what I just did here, right? He took the orders that they got from the previous month and they just multiplied it by 110%, drag that formula across the entire sheet. And if you do that, you'll come up with this, right? And it's this beautiful, beautiful hockey stick chart that, oh God, am I sharing the wrong screen? I am sharing the wrong screen. Damn it. I've made all these nice slides to prove this point. Let me go back for a second. Sorry. Let me go back. Sorry. Yeah, kind of like the point I was making with all of this is, yeah, here it is. Sorry. Uh, too many screens, too little real estate. Okay, back to this. Yeah, so a founder once told me this, right? It's like, hey, we're going to generate $700 when we launch, then we're going to grow that number by 10% every month. And again, if you put that into a formula, it looks like something like this, where you multiply by 110%. Again, that generates this beautiful hockey stick chart, which looks great on a pitch deck, right? A hockey stick chart. But if it's just, a number multiplied by 110%, like there's no real value. There's no real value to that number. It's just a spreadsheet number, and anybody can do it. But truly, guys, we see these on pitch decks. We see them a lot, and I actually see them from experienced founders too. They're kind of feeling this requirement to have a chart on the pitch deck. But it's not enough, right? So how do we do it right? That's what this session today is about. Hopefully, I've made a good example of this. Okay, so what we need to think about is that growth, right? This 10% growth every month doesn't just come, right? It's not that because we exist, we're going to grow 10% month over month. No, we have to do something to generate that growth. That's usually going to be marketing, as Ali said, or it's going to be sales. But we have to do one of those things to generate that growth, and we have to understand how much of that thing we're doing and how much growth does that generate, right? Because both of these things, sales or marketing, depending on whether you're B2C or B2B, both of these things cost money, right? So we have to understand, well, how much money do we need to put into these things so that we can generate growth on the other end, right? And in the end, the model, and remember I mentioned that the spreadsheet is a bit of a budgeting thing, right? It's like a little budget for your company. We have revenue, right? That's green, that goes up, that's positive. We have expenses. We have those costs in red, and we have the salaries and the other stuff in blue. And we are always budgeting, right? We're always thinking, okay, how much money do we need to get to this milestone? How much money do we need to raise our next round or to get to profitability? We're always using this sheet to estimate how much time do we have or how much money do we have to get to those milestones. But the question is, well, what's driving growth? What thing that the company does is the thing that drives extra revenue? And what thing that the company does is the thing that drives more expenses, right? Because those two are driven by something. They're just not 10% every month. So let's think of options, right? What's driving orders in your company? And orders might be traffic or subscriptions or monthly active users. If you're Uber, that's going to be the number of drivers or the number of riders. So what do you do? What does a company do to drive more orders, to drive more traffic? And at the same time, these orders drive things, right? We talked a little bit about costs where if we are this e-commerce company and we're selling more t-shirts and we're selling more items, we have to spend more in shipping, right? So there are things that we do that, when we generate more revenue, there are other things that have to grow as well as we create more revenue, right? For example, those might be fulfillment costs if we're shipping physical items. Those might be hosting costs if we're, or AI API costs, right? If we're using some form of AI. Maybe there's the support staff, right? The bigger our revenue, the bigger our customer base, the more support team we're going to need. I guess AI can automate some of that now, or if you're doing manual work account managers, B2B, you're going to need more humans, right? So there's some, what we're finding out with all of this is that some things are kind of connected to each other, right? Some things drive each other. So if you think of revenue as the core of what we do, right? As the core metric that we're trying to track or that we're trying to forecast for, to present to these investors. Well, the first thing that we notice is that, well, if we generate more revenue, we're going to have more costs, right? If we have more revenue, there are certain things like costs, like hosting, like fulfillments, like shipping, that are going to scale alongside our revenue. But and perhaps more, and that was maybe more obvious, and I think a lot of founders often get that part right. But the part that they get wrong is, well, revenue doesn't happen just magically. There is something that we must do to create more revenue. So the input in the model, the input when we forecast, is not 10%, right? It's you see these sheets where what founders change is like, oh, what if we grow at 10%? Or what if we grow at 8%? What if we grow at 20%? Right. And you have these like different peaks of hockey stick charts. But that's not what this forecast is about. It's about understanding what do we do to drive more revenue. So let's look at a few potential revenue drivers. The easiest one, Ali already threw it there in the chat. The easiest one to think of is paid marketing, right? Paid marketing is an obvious, very controllable revenue driver. Paid marketing might be SEM, might be display, might be retargeting. I wouldn't call a lot of, as a YouTuber, I guess, a lot of marketing also happens through influencers, right? And I would also call that paid marketing campaigns, right? You have to think about, you know, paying some influencer to do a TikTok or to sponsor an ad. It's paid marketing in the end, and you have to track it somehow. Another potential driver could be outbound sales, right? Maybe you're a B2B company, and you're selling to enterprise, for example, and it's not that you're going to go and market to the executive team in that marketing company, sorry, in that enterprise. You're probably going to have to do some direct outreach, right? Maybe some business development. Maybe you'll need to go to a conference, right? So like that's where you do outbound sales, and that's also an expense. Another potential driver of growth is organic traffic, right? Organic traffic could be driven by social media, by SEO, PR, customer referrals, but also these things aren't free, right? And another potential driver of growth could be returning customers, right? If you're a SaaS business, we saw that a little bit with churn, right? The better your retention, the more customers you have, and all of these are potential drivers of revenue. But they're not all created equal. And based on the color coding that we've been using in this spreadsheet, we could color code this a little bit, where we have blue for something that's a direct expense, right? There's almost a direct proportion between paid marketing and signups, or between outbound sales and leads. Whereas with organic traffic and returning customers, not necessarily, right? If you think about organic traffic or SEO, for example, there's definitely a marketing team that drives that organic traffic. But think of it this way: if you double your paid marketing budget, right? If you double this item here at the top, you should more or less double your traffic, right? Because those are two connected. But if you double your marketing team, do you double your organic traffic? Not necessarily, right? Those are not directly tied. And it's an important difference. But either way, all of these potential drivers, they generate revenue, right? Which is the metric that we want to track. And the key thing that you want to understand, if there's one slide that you want to screenshot or steal from today's session, is this one. What we have to understand is how do we convert one to the other, right? How do we convert paid marketing dollars into revenue? Well, we can use a cost of acquisition, right? Depending on how many dollars we spend, we'll generate X amount of revenue because of the number of customers. We can also convert outbound sales team into revenue by tracking the sales per agent, right? Or we could also take the organic traffic and convert it, right? Take a conversion rate from organic traffic to revenue and figure out how much that's going to scale. Same with returning customers, right? We can define a churn rate or a retention rate to estimate. But the key thing about all of these blue text over the arrow is we don't have to make those up. There are a ton of references online of what a cost of acquisition might be. For example, from paid marketing to sign up on a free trial, the normal cost of acquisition is probably going to be somewhere between $10 and $30. That's pretty standard. And if you have a model and you suddenly assume that it's going to be $1 per sign up for you, you're estimating something that's so odd, right? So weird that doesn't happen, that kind of already starts to become a little suspicious. But I'm going to dig deeper into this in a sec. So before we do, let's do a reminder on color coding. We have revenue is green. That's the color of money. We have costs as red. That's like Slidebean red. Maybe you call it magenta, but we call it red. We have sales, general, and admin expenses as blue. And we have another category that's called capital expenditures, which we don't use that much, but you're going to see it color-coded in the model too. Okay, so I'm going to walk you through a couple of models. We want to think of these as flowcharts, sort of, right? So X drives Y. Again, we know that revenue drives costs, and we know that our drivers drive revenue, right? So let's break this down a little bit and extend it. Now, does anybody in the Zoom link have either a SaaS or an e-commerce business that they want to give us as an example? If you do, raise a hand. Otherwise, I can use an example. Also, if you guys on YouTube, if you want us to give us your example, join the Zoom session. The link is all the way at the top of the, or on the description if you want to kind of move to the Zoom session so we can chat. Okay, I'm going to walk you through a couple examples, and then we'll use that example and we'll work on that on a sheet, right? But let's first understand how to map it. We call these things financial model maps, and they're like this visual mind map of how we want to be thinking of revenue, right, from A to B. So in this e-commerce example, right, we kind of talked about e-commerce already. Again, we always want to go to revenue, right? We want to track what our revenue is, but if we look at the drivers of that, how do you drive revenue for e-commerce? Two ways, or at least in this model, we have two main channels. One is paid marketing, right, where we spend a certain amount of money in paid marketing, and we have a cost of acquisition per order, right? So we have from paid marketing, we assume this cost of acquisition, and that drives orders. And then from organic traffic too, right? We might get organic traffic from Amazon because we rank well, or because we're doing some SEO efforts. That could be another driver. So we have organic traffic as a driver. We have a conversion rate from organic traffic to orders. Basically, what we're saying is for every 1,000 visits that we get to our website, we're going to have 1% of those visits purchase. And that's actually not a bad reference. A 1%, 1 to 3% conversion rates from organic to e-commerce, I would say, is pretty standard. You can Google all these numbers. I'm not making them up. And they're also not state secrets. Companies are often willing to share at least a ballpark range of what their metrics are. But both of those, if you look at both of those, they'll add to this metric that we have, this larger white box that's new orders. And for every new order, we're going to have revenue per order, right? That's another input that we make. Notice that those are blue because they're inputs. Remember the spreadsheet, right? The stuff that we input is blue. We have from orders of revenue per order that drives our order revenue. And for every new order, we also have to do shipping and handling, right? So this little map is kind of telling us, it's kind of mapping everything where we have these variables that we're adjusting, but really the stuff that we control is this, right? Nowhere in this sheet or nowhere in this model do you have an input to say 10% growth or 20% growth or 15% growth. No, because that's not the way it works. What you have control over is how much you spend every month in paid marketing, and you have a little bit of control, right? Or you can predict a little bit. You can predict a little bit, organic traffic and how for example, how it's been growing or how other comparable companies have their organic traffic grow with time. Let's look at another one. Let's look at a SaaS business. So in a SaaS business, we have the same drivers, right? So in this case, we're doing paid marketing and organic traffic just as before. But instead of purchases, instead of orders from this item in a SaaS business or self-service SaaS, which think of a self-service as a SaaS business where you sign up on your own and you do stuff on your own, not without involvement of a sales team. Think of like ClickUp, for example, where or Google Workspace, where you sign up for this thing on your own. There's nobody selling you, or there's no sales call that you jump into. You just sign up, you'll use the free version for a while, and if you're convinced by it, you'll convert to the paid version. So that's what we're trying to map here. We have paid marketing and organic traffic as drivers. That drives these ideas of free signups, free trials. And then from the number of free signups that we have this conversion rate, right? So from free signups, we convert some of them into customers. Now, those conversion rates, again, are not rocket science. They're not state secrets, right? Companies are willing to share what our conversion rate is. I can tell you that our conversion rate in the US for our product, for our platform Slidebean is about 5%. I'd say 4 to 5%. And while in other countries, right, in developing countries, our conversion rate is probably closer to 1%. And those are not crazy numbers. If you're based in Latin America, for example, and you're building this product that targets Latin American customers, then you should probably come up with an assumption of 1%, because that's what it's going to be. You can't come up with and say, oh, it's going to be 10%, because that would be crazy, right? That doesn't happen. It's too good of a conversion rate. And again, all of these metrics you can find online. But when we have conversion rate to customers, then we have we convert that into revenue for sales and then into hosting costs. So let's actually build one now. I didn't see anybody raise a hand, so I'm just gonna have to come up with some examples of my own. But let's actually build one of these models in the good spreadsheet. So I'm gonna share my screen here into this one. Yep. Okay. So we're back to the sheet. Hopefully I didn't lose you. So by the way, those little models that I made, we have a little template for that in this mirror board. It's you can modify them, you can use them as building blocks, because some businesses are different from this, right? You have inbound sales, where, for example, inbound SaaS, where, for example, you do have to deal with leads, and those leads are managed by an inbound sales team, right? So, for example, here we'll see that depending on the number of leads, we have this team that has to scale alongside those leads. We have model maps for a mobile app and for like a news website, like a content creation media company, for a marketplace, or like a two-sided or one-sided marketplace. So you can use and copy those as references. But what we have done too is we've built this financial model that has the formulas ready for you to do this. Which is what I'm going to walk you through, and we're going to be working, I guess, the rest of the session. Since you all asked me already, and before you guys think that I'm just clickbaiting you, I'm going to give you the link where you can download this one. So I guess skip some slides. There we go. That's the good sheet. So you can scan that QR code, or you can just snatch that code. Josh from my team is going to paste the link in the chat, so you can grab it if you need to. This is free, by the way. Once again, it's a completely free spreadsheet. So that being said, let me move over and show you how it works. Okay, so this one, yeah, at least in this sheet, which is called FS Month, the financial statement, is not too different from the one that we saw earlier. Right? We notice that we have revenue, we have costs, we have expenses, but we can't edit these anymore. Right? These are all grayed out. Not grayed out, sorry. These are all black numbers, and that means that the numbers here are coming from somewhere else. They're coming from they're coming from somewhere else in the spreadsheet, right? So we can't, or we shouldn't, edit these numbers. What we can edit is the blue numbers, not the black numbers. And most of that we are going to control from assumptions, right? So here in assumptions, first of all, we have this sample revenue line, right? And we can use a SaaS or an e-commerce to start. But before we even do that, let's go a little lower and start by creating a team, right? So let's create a team for this company. Now we're in January, and raising money for a startup usually takes about 6 months, right? So that's one thing that we have to kind of start dealing with. That if Bob and if the CEO is going to be Bob from the Zoom, you've been putting a lot of effort, Ali. So maybe the CEO is going to be Ali. I'm going to hire Ali to our startup as well, and the CTO is going to be JavaWorks. Right, so there's this little eclectic group of founders. Yeah, so we're just going to enable these roles for everybody and define a salary. And normally, I like to, have, salaries should probably be the same for all founders, but that's fair, at least at the beginning of the process. And more importantly, they should not be market salaries, right? It'd be really weird if you guys start paying yourselves $200,000 a year for a business that's just starting up. That's, investors, something's fishy about it, right? So your bare minimum salary, under market for sure. And then the start date, right? So here in the monthly sheet, notice that we have this milestone section. The model starts here. This is where we are now, right? We're in January. And like I said, raising money normally takes about 6 months. So if you were to start pitching investors now, it's almost February. Chances are you're going to close your pre-seed somewhere around here. So we have to deal with the reality that this company is not going to have investor capital for about 6 months, and we have to plan around that, and we have to budget around that. So what's important here is that the model is more than just like this budget that you present to investors. This is reality, right? This is what your reality should look like. So let's think of so let's go back to the assumptions and say, well, when are these people going to start? Well, they're going to start at pre-seed close, right? We're going to start paying them a salary when our pre-seed round closes, not before. So if we go to the monthly sheet, notice that here our cash balance is 0. We're not spending any money. And now after July, we are spending money. We have some expenses. Now, we might think that how much is a pre-seed round? Actually, the median pre-seed round in 2025 in the US was $900,000. So let's maybe assume that that's the money that you can aspire to raise. Now, that being said, you're probably going to have to spend a little bit of money before that, right? You're going to have to do a couple of business dinners. You're going to have to maybe have an office. So maybe we can assume that the founders maybe pitched in $10,000 altogether, 3,000 each, and we'll have that little that small fund of $10,000 for the occasional expense. For example, costs, right? Here in costs, we are probably going to have to start paying AWS now if we want to start developing. So we can assume that there's a little bit of cost in that, or a landing page too. We'll need some Webflow. So we can add some of that too. And notice that here, this is a bit of a budgeting sheet, right? Where we have this capital injection of 9,000. We'll spend some of it. We'll eat out of that budget because there's stuff that we need to spend regardless. Now, what happens at pre-seed close? Let's go back to assumptions. When we close that pre-seed, maybe we'll start a little bit of a hiring spree. So here on the staff sheet, notice that I went here from assumptions. I went to the staff sheet. We might need to start hiring some people. So for example, maybe a marketing team, right? Let's assume that this is a SaaS thing. We'll have a senior marketing role, and we can enable this role. We can do that in 2 ways. We can do that as a single hire, where we have somebody that again starts when we close the pre-seed, has a salary, has payroll taxes, benefits, and has an annual salary increase. You can even assume equity, and we have a cap table tool that you can use for that. I'm not going to get into that today. But in this, but you can also start this as a scaling team, right? And say, well, we're going to have a marketing team that scales alongside the company. They'll start when we close the pre-seed. We'll start that hiring. They're maybe going to make 80 a year because they're senior marketing people, and we're going to hire 1 every quarter until we get to a cap of 5. So notice if we go to SG&A here, we'll kind of see that staff budget scaling, right? This is the founders and that first role. And then 3 months later, you have an extra role. And then 3 months later, another one. You can expand staff here. You can see staff here where the headcount is founders plus 1, and then 5 people, and then 6 people, and then 7 people, and so on. And you can do this for any role, right? So let's assume that we have to build a product too. That we're coding at the very beginning, it's only going to be the CTO, or maybe we'll have a part-time or a junior developer helping the CTO. Maybe that person starts now. Right? Maybe that's a single hire. It starts February, and we don't pay them that much. Maybe they're part-time or they're remote elsewhere in the world. Maybe we can budget, I don't know, $1,000 a month. So $1,200 a year. And again, by doing that, we're eating from our little budget that we created. We still have enough. But notice that the model is budgeting for that staff persona. And then once we raise money, right, we can start hiring senior developers too on this scaling team that starts at the pre-seed close. Maybe these engineers have to make not million, 100K a year. And again, we're hiring, I don't know, a couple of engineers every quarter as we add to this team. Now, by just doing that in this sheet, what we've done is we've budgeted basically, right? We have this 900K round. And now we're just eating money out of that round, and eventually it's going to run out. Notice that we've essentially bought ourselves time between July 2026 and June 2027. That means that by June 2027, we need to close another round. And I don't know if that's possible, but let's first talk about revenue. We'll see. So let's go back to assumptions here and enable this SaaS model. Let's assume this is going to be a SaaS company. Okay. So, well, this SaaS business, we're going to assume that it needs a launch date, right? And we've established, if we remember, that we're going to raise pre-seed in July. That means that after we raise, after we hire this team, the marketing team, and so on, we should be able to launch, let's say, a couple months after that. So let's set our launch date, conservatively for September 2026. Notice that we have now some inputs here. We can define, for example, how much organic traffic we have at launch. So let's say that the website's going to get about 1,000 visits a month, and that's going to grow by 10%. Now that doesn't happen magically, right? We've created this role of a marketing persona that starts at pre-seed close, so 2 months before this, which means that it's not completely crazy to say that the work that this team is doing is going to drive 1,000 visits, and those visits are going to grow because they're doing some SEO, some social media. And then we have that conversion rate, right, from the traffic to the website to sign up. 15%, I think, is a standard. We could maybe set it to 12% to be a little bit more conservative. That's organic acquisition. Now we could also deal with paid acquisition, right? We could start a marketing budget here that generates us some leads. Maybe we'll be more aggressive. We'll maybe start about $5,000. We've raised a little bit of money now, so we have that bucket of money to spend, and we can grow that budget too, right? Every month we spend a little more. We're using money from our round. And the expected cost per sign up, I told you that a good reference is something like $15 a month. Sorry, $15 per sign up. So we should set that. And then conversions, right? We said that there's a sign up to paid conversion of 5. That's what I've seen, at least in the US. Maybe because this product is new, it's fresh, it's only starting. Maybe we want to be a little bit more conservative. And then the average revenue per user, that's our subscription. Let's say that this is a $99 a month product, just like before. There's a churn rate of 5%. We need hosting costs. So every user is going to cost us a little bit of money. The model will take care of that. Let's say that our hosting costs will be a couple of dollars per user, and that we need to pay for credit card processing. Stripe and similar platforms will charge you about 2.9%. So these inputs that I've been working on here are basically these inputs, right? When the cost per sign up, and the conversion rate, and the conversion rate here, and the hosting costs, right? We have those inputs ready, and the main drivers here are that organic traffic and that paid marketing budget, which is what we've done here, right? These are the main drivers that we're forecasting for. So what does that do, right? We've added some actual good logic to the model. What is it doing? Let's start with the annual model. The zoomed out version, right? Annually, if we start this business now, 2026, we're looking at a company that might be making $100 million a year in revenue by 2032, which is not bad. It's not bad at all. We could maybe be a little bit more aggressive. We probably want to aim for a few $100 million in revenue, like assuming that this is the market, but this is not bad at all. So I'm just going to assume that this is correct, that that we're on the right track here. And of course, we don't have enough money to get there, right? We have to. Because we're spending money, we have this big team that's scaling, and we have to scale the team first and then the revenue. All these years for this company, they're not profitable yet. And that's what investors are funding, right? They're funding the unprofitable years so that later we can turn a profit and sell this company. And now the question with the model is, well, are we forecasting for the right milestones, right? Remember that we told you earlier, it's not just about months of runway, it's about it's about raising money in the next milestone. So what are good milestones? Well, I'll tell you that a milestone for a seed company, for a seed round today, in this day and age, is somewhere around 30, let's say 30K in MRR. When you have about 30K in MRR, I think that you're in a good position to go and pitch investors. So if we set that to maybe here, where we have, so here right now, right, we have this $32,000 that happened here. This is the seed round. Seed round pitch. Right, that's very important. That's when we can start talking to investors, right? We have enough metrics to go and convince an investor. But closing a round will take months, about 6 months. So right now, let's say that we start pitching investors in November, we'd probably be closing that round around here. And we are $1.5 million short of getting there. So that's the first thing that this model is telling us. Like the money that we set here at pre-seed is not enough to get us to here, and we will go out of business. Now, an easy answer could be, well, let's just raise $3 million as a pre-seed. But that also doesn't work so well because a $3 million pre-seed, that's a huge pre-seed. You don't see that very often. I see your question, Andy. How long can you be not profitable till you can't raise more rounds anymore? You have companies that go public without being profitable. There's no time limit on that. I think what it really depends is in your capacity to keep closing rounds of funding, which normally startups can do as long as they have an exciting business case, right? As long as they're on a path to eventual profitability or to an exit, and as long as revenue keeps growing. If your company stalls and revenue is not growing, that makes it really hard to raise money. To your question, investors don't care at all. No, they do care of profits, but not for a while, right? The whole thing with venture capital investors is that they're looking for the unicorn, and the unicorn will lose money for many years. That's just the reality of it. So yeah, profits now are not too exciting for investors versus being able to sell a unicorn later, right? And that's the whole point of venture capital. We have a couple of videos on this, by the way. You can browse in our YouTube channel. Josh can maybe paste the link to our Startup Club channel. We have a bunch of videos on profitability. We actually one that went live last week on why investors care about one or the other. Okay. But back to the point here is like we can't raise 3 million pre-seed. We can only raise 900,000, but it's not enough, right? It's not enough to get here. So what do we do? What do we do? We need to be able to fund this period of time. Now we're closing a pre-seed in July 2026, and right now our seed is set for April 2028, which is what a year and a half later. That's actually not too bad. That is not too bad. Closing rounds 24 months apart. That's more or less what companies are doing today, right? So for July 2026, 2 years would be July 2028. Again, so we're assuming that we reach seed stage, like 12, 15 months later, and we closed around maybe 18 months later. That's fine. I think that's fine. The problem is it's not enough. And what do we do? Well, we have to be more capital efficient. If we want to get here without running out of money, we have to be more capital efficient. Again, assuming that we can raise more than $900,000, which is the standard in today's day and age, we just have to be more capital efficient. And that means that we have to assume fewer people, right? Maybe we're going to cap our senior marketing team at 3, or 3 people. We're going to have to pay them less, which means that we're probably going to have to compensate them more with equity. With their cap table position is going to be more than this. Us founders, we're probably gonna have to pay ourselves less as well, right? So we're maybe setting ourselves at 45K, so we don't have to spend that much money. This we can control from here, 45. What else? Senior developers, right? We have this large senior development team all the way up to 10. Let's cut it just 1 person every quarter and cap that team at 4. Maybe this junior developer that we hire, we can let them go after we close the pre-seed, right? We don't need them, so we can write off that position. There's an end date function here too. Let's see what that does. Well, okay. So we're getting somewhere, right? We're about $200,000 short of getting to seed close. Almost there. What else can we do? Well, we can maybe assume, that we're gonna work harder, right? We're gonna come up with some new marketing strategy, and maybe that's gonna allow us to grow our organic traffic a little faster. Maybe it doesn't start at 1,000 visits; it starts at 1,500, and maybe we grow it at 12%, right? We're just gonna, think harder, or I don't know, come up with some better alternatives, right? We're not notice that I'm not changing. There are some numbers that we can't really change, right? Traffic to sign up, we can't assume that it's more than 12. Sign up to paid, we can't assume it's more than 3, right? Because that'd be unrealistic. I can just easily go and say 10% here. That makes the whole model extremely profitable. We don't need money at all, but this is just unrealistic. So we can't use 10. So we have to stay within the constraints of what a realistic company can do. But still, by doing that, notice that we are very close. We're very, very close. We're only about $100,000 short. You could maybe get away with that. You can maybe get away with raising $1 million and 1.1 million. Right? It's like 1.1 million. That gets you to seed close with a little bit of a cushion, and that allows you at seed to go and raise another round. This back and forth this game of, okay, like, is it not enough? Do I cut a budget here? Do I cut some expenses here? That is the game of financial modeling. That's what you should be doing before you go in front of an investor, just to show them that, hey, this is the math that we run. We believe in these numbers. We stand by these numbers. And this is our hiring budget. You need to have all of that solved. This is not only our hiring budget, but our marketing scaling budget, our marketing plans. You could play around with other stuff. For example, say, well, what if we start more aggressively with marketing? What if we start at 10,000 instead of 5,000? What does that do? It actually helps. If we start more aggressive, if you spend more at the beginning and that conversion rate holds, you actually need less money than before, right? So all of that kind of plays into account, and you need a tool that can let you play around with those scenarios. That's the whole point of financial modeling. So I'm going to link back to the spreadsheet if you weren't convinced earlier to give this a shot as you forecast your round. Now grab a chance to download it. Now, this sheet that I've been using includes, as you can see, some functionality to forecast for SaaS and some functionality for a simple SaaS business, and some functionality to forecast for e-commerce, right? But not all businesses kind of fit that criteria. So we have a couple of resources that could help adjust this sheet. First of all, we have a course on how to build one of these sheets. It's called our Financial Modeling Bootcamp. It goes all the way back to building the maps, understanding drivers, understanding how to build it, and how to connect formulas in the sheet. That's probably the customization that you need to do. Again, I expect most of you can start working with the SaaS model, but this sheet has over 4 different revenue models, so you can customize. Maybe your business has a little bit of SaaS, a little bit of platform as a service. Maybe there's some virality baked in. So our bootcamp can really kind of teach you how to do that. It's just $99. And sorry, my team's going to paste the link there to the bootcamp, Josh. And also, if you are not that savvy building spreadsheets, if you're not that comfortable kind of creating spreadsheets of your own and connecting formulas and so on, because it can be a little tedious, we actually have a system or a service where our team builds the spreadsheet for you. We build it for you, we keep it up to date, and we sync it to your actuals, to your P&L, and we talk to your accounting team to make sure that the spreadsheet reflects the reality of your business. That all goes for $199 a month for a pre-revenue company. And you get access to all of our platform, including our cap table, including our pitch deck builder, including our investor finder, and access to our team. Even this fractional CFO model actually includes time with me every couple months to go over your assumptions, understand and make sure that you're forecasting correctly. I have some, I can't speak to specific companies, but I have memorized some general metrics of what metrics are expected and what investors expect to see, how other companies have performed as they scale. So our team, myself and our team can definitely help with that. And we understand that you guys are all starting up, or most of you, so we try to price it at a place where it's not too much of a burden for starters. So that's that's the little commercial. In the time that we have left, I have time for questions. Let's see if you have any. Raise a hand in the Zoom. Oh, the link for the spreadsheet doesn't work. Oh, that sucks. That's weird. Let me try and find it. That's weird. Josh, can you check the link? That's really odd. It did work for me, so I'll paste it here for everyone. That's the link to the good sheet, Shari. Any other questions? So yeah, Shari, here's the right link. Jer, Fletch, we don't have a model for enterprise SaaS. The thing is with enterprise SaaS is, we don't have like a template that's built for enterprise SaaS, because enterprise SaaS is just very variable, right? It depends a lot on the service that you're offering, pricing. The driver for enterprise is probably going to be sales much more than outbound sales, much more than marketing. And the cost of running that service is probably going to be a lot too. So we don't have one, but it's not too hard to customize one from the resources that we have. In the bootcamp, like I said, we have some materials on how to build one from scratch. So hopefully that's useful. Dean is saying, very helpful session. Do you have any templates for med tech or biotech startups? Not that we've built already, but like I said, kind of like the basis or like the root of what I've been going through is in these model maps, right? To your question, Jared Fletcher, here's outbound sales, which kind of fits enterprise SaaS, where you have an outbound sales team, that's the driver. So in the staff sheet that we were using in the model, um, not the intro model, this one, right? What we would basically say is, well, there's a sales team here, and maybe there's a scaling team in that sales team and that's what drives revenue, right? So the bigger the sales team, the more revenue we have. So instead of forecasting using paid marketing like we did before, you forecast using the size of your sales team. So that could be one way to do it. Yeah. So here's the flow chart of how an enterprise size SaaS could look like. But again, it probably requires some customization, and you can use the template. This template that we have has, notice that we were using all this time. We were working on revenue line one, right? This is the SaaS model that we forecasted with, but we have all this space where you can kind of bring in and run your own formulas, and that's what we go into in the bootcamp, kind of teaching you how to build formulas on your own into the spreadsheet that we've already built. Yeah. Okay. So Dean, do you have templates for medtech or biotech? Again, also like it's very, what is a biotech startup, right? It's a lot of R&D at first, so a lot of staff, a lot of expenses first, and then revenue probably further down the line. So it's all about kind of understanding, the budget that you need to hit those milestones, and then the revenue model, which again may be very different. You might be selling your patents or renting the patents, or selling an actual physical product. So because all biotech companies are so different, we tried building templates for common business models, but there's a point where building a template that works for everyone is so complex that it just makes it counterproductive. And you end up with this spreadsheet that tries to do everything, but it's just really complicated to use. Trust me, we tried that path in the past. Andy, should you build multiple budgets, like one conservative and one more aggressive, to give investors a choice in investing 900K versus 1.5 million? That's actually a really good question. I would not recommend doing that. I think that just creates like it makes this work that we did today, it makes it twice as hard because you have to do it twice. You normally don't want to do that. And there's normally only one really good path for a business, right? For example, if you choose the bootstrapping or the slow path, where you're running slowly, and maybe there's a competitor that outruns you, or maybe there's that comes with its own set of risks. Whereas kind of like the ideal path is usually, hey, we want to operate at this speed and we want to beat these competitors, right? In my opinion, there's usually only one ideal path in terms of how much money you want to raise. And these scenarios of spending less or spending more, that's kind of your homework. And what you want to bring to the investors is present them with a really good case of, hey, this is what we expect to do in this right order. And that's the right way because we've looked at the other alternatives and those aren't the best. Yeah, it's also like a bit of a cognitive overload for the investors, right? To try to present them and have them decide. They'll either invest in you or not. And they already have a number in mind of how much money they're willing to put into into startups. So I don't think it's it's not that they choose, right, if they invest one or the other. It's your choice as founder. And your choice as founder should also be kind of educated and saying, well, if an investor comes in, we looked at this model, right? The little one that we built says that you need $1.1 million to raise this round. I'm sorry, to get to the next milestone. If an investor comes in and says, hey, I will only give you 500K, can you make your business work with that? The very clear answer we found is no, right? Like this business can't get to seed stage with only 500K. There's no way. You'd have to cut practically all the staff, which means that you have to assume that marketing, that the product takes longer to build, and maybe marketing isn't as aggressive because you don't have staff to market, right? So like, there's probably only one clear path. And again, if you only raise, and this is, I think, a good answer that investors want to hear is like, well, what if you only raise half of this round? Then your answer should be, then we won't raise it because we can't we can't get to the next milestone if we don't raise it. And we have to be, as founders, we should be like thorough about, knowing that what we've put in the spreadsheet is the bare minimum that we can raise. That should always be the case. If we raise less than this, it's impossible, right? If we raise more, maybe two more investors are interested, we can be a little faster. We can deploy faster, we can reduce risk. But your spreadsheet should be close to the bare minimum that you can raise. Andy's asking, but aren't we guessing so many variables like CAC and traffic and conversion rate? It feels like a house of cards. That's true. I mean, I get your analogy, and I'm glad you asked the question this way. Yes, it's a bunch of different assumptions. We want to keep them again as simple as possible so that we reduce the potential risk. But it's less risky. I mean, this starts to get less risky first when you use assumptions that are real, right? When you Google each one of these assumptions and you search and you confirm that that's a good standard of metrics, right? That's your first kind of de-risking of your assumptions. And the second, and by far the most important one, is the moment you launch, you have real numbers. The moment you launch, you can replace variables that are guesswork with variables that are historicals. And that's where these spreadsheets become almost like a Palantir, not the company, but the Lord of the Rings reference. Like they when they can predict the future, because if you've seen this performance in the past, you can assume that that performance will continue. And assuming that nothing major changes, etc. But that's where historicals are very important. It's very hard to forecast when you haven't launched. You have to go by house of card assumptions, I guess. But using existing references is by far the best way to keep that sane and safe and make sure that you're not kind of inventing numbers that or making numbers up that are just unrealistic. All right. Right on the hour. I don't see any more questions. Jared Fletcher, yeah, asking if there's a link to the recording. Yes, I'm going to paste a link to our YouTube channel where you can find this session and rewatch. To you guys on YouTube, thanks a lot for tuning in. To you guys on Zoom as well. Remember, if you need our help, if you feel a little lost with this, make sure you can book some time with our team. If you're pretty good at spreadsheets, take a look at our bootcamp. It can kind of teach you how to build models for practically every business, and that's what we try to do with that. So self-service versus assistance from our team, two approaches depending on how comfortable you are with spreadsheets. But thanks a lot for tuning in, and we'll see you.